All right, y'all. So in this video, it's gonna be a lot going on, but I make this video so you guys can see how you can pay your any debt you have faster if you need to or if you want to. Um, so in this situation, I'm going to use a car loan to provide this example. So let's say you have a car loan of $20,000. The interest rate is at 4%. The years for the loan is six years. That will make the monthly payment at $312.90. Now over here we have our debt tools. So these are what we're going to use to help us pay the debt faster and to save interest as well. So now let's say you have a credit card for $20,000 and then you have a line of credit at 10% for $10,000. And now let's say we have a budget of our monthly budget, our income is 3,200. And so let's say your paycheck from your job is or business or whatnot. Let's just say your monthly amount is 3,200. This will be after taxes. So this is what you will receive if you have a job and you're paying taxes and all that. Well, your employer is withholding taxes. You will get 3,200 after your job withholds everything, and your expenses is $3,000. That will give you an extra cash, leave you with extra cash of $200 a month. And so this is that extra cash is what we're gonna use to pay back the debt on the debt tools, specifically the line of credit. The credit card is involved as well, but we're really paying back the line of credit with the extra cash. So so over here, these are the months. These are the 1, 2, 3. These are the months. And then in this column is just which month it is, and then it's telling you the ending balances, right? This month is just, this column is what type of transaction is happening. So we have either a chunk, an expense, or the paychecks, or either a credit card payment as well. So the chunk, we'll get into that later. The bank. So now you have a bank, your bank account. In this scenario, we're only going to use it once, and we're not going to use it ever again, really. Your line of credit is this is the column for your line of credit. So these were just showing the transactions happening with the line of credit. Your credit card is this column, right? And then we have our car loan balance. So this is the car loan column, and then over here is our net equity. So right now you can see that it's at negative 17,000. And so when you see the parentheses, that just means it's going to be a negative. And then as it builds up, when it's positive, that means we don't owe anything, or we don't have any debt or whatnot. That's our equity. Let's say that. So let's get into this. Now let's say you got the loan, the car loan, and you're at the start of paying it back. So you have $3,000 in your bank account, right? You have $20,000 to pay back, and then the line of credit and the credit card, these balances are at zero. You haven't used them yet. They're available, right? But you haven't used them yet. So your credit card is in your wallet, and your line of credit is you go online and you got an account. Let's see. So your bank account is at 3,000. Your line of credit card is at zero. Car loan is at negative 2,000, 20,000, which will give you a net equity of negative 17,000. So negative 20,000 minus the 3,000 will give you negative 17,000. So this is how much of your personal equity you have. Right here, the first thing you're gonna do is all of this cash in the bank account, in your bank account, you're gonna put it towards the car loan, right? Knock that principal down on the car loan. Then you're gonna take the line of credit as well and knock that principal down as well. So you take a 3,000 from the bank account, 3,000 from the line of credit, and you're giving that 6,000 in total from these both towards the car loan. And so yeah, so we're using the line of credit to do that because the line of credit has a lower interest than the credit card, right? And so let's continue so we can get understand better how this is going to work. Take that 3,000, negative 3,000 from your bank account, negative 3,000 from line of credit, put it towards the car loan. Keep in mind that your line of credit, you see how this negative 3,000 would be about 30% of this $10,000. Well, it is 30% of the $10,000. You don't want to use too much of the line of credit because that can affect your credit utilization. So just keep that in mind. I'm not going to get deep into that, but just keep that in mind. That's why I'm only using negative $3,000 in this situation, right? And you always want to work the numbers just to see how things are going to work out. So now, let's go down here. So let's say in the month of January, you have your expenses. Expenses coming out different days and things like that. But it's negative. It's $3,000 for your expenses. Now your living expenses, your daily expenses, you're going to put as much as you can on a credit card. In this scenario, I have the entire $3,000 going on the credit card. Now, obviously, some things you can't pay for with the credit card, like rent, for instance, a mortgage, things like that. You can't put everything on a credit card. So I understand that. But in this situation, I'm just keeping it simple and saying, hey, every expense, all the expenses are going on the credit card. And you're going to do this because this is going to help you use the bank's money so you can keep your cash on hand, right? So we'll get more to it. Let's go down. Let's go over. So now the car loan, remember, after the chunk, you also have to make the monthly payment on the car loan. So that $312.90 on this first month, this first payment, you're gonna have $246.23 go towards the principal of the car loan, right? Yeah, so that's gonna deduct or reduce the amount of principal on the car loan in addition to the chunk right here, which will give you down here the ending balance of $13,753, right? So now let's go down here. Now let's say you get 2 paychecks each month. So let's say one on the 15th, one on the 30th. Let's just say the first paycheck $1,600, the second paycheck $1,600. Now you see how you have this negative $3,000 balance on the line of credit. You're going to be charged interest because you used that $3,000. So you're going to be charged interest on that. So now what you're going to do is when you get your paychecks, you're going to put them directly towards the line of credit. You're not going to put it in your bank account. If it has to come to your bank account, then you just make a transfer and put it in your line of credit. It's like you're paying your line of credit back. Now, if you're wondering, well, if I paid my money back towards line of credit, how am I going to have cash to buy things? Well, that's what you have the credit card for. And remember, you can always just use the line of credit. If you need cash, just use the line of credit, right? So whatever expenses you can't put on the credit card, you just take it from the line of credit. Or if you need to put a little bit keep a little bit in your bank account, that's fine too. If you have to, but just get the general idea that you can always just borrow from these two, the line of credit and the credit card. So now, once you did that, so you knocked off the car loan, right? You knocked off some of the car loan, like $6,000 or whatnot. And now when you got your paycheck, it's like you paid your line of credit back. So now you don't even owe interest on the line of credit, or as much interest on the line of credit. It's not going to be that much. And then your credit card, right? It has a negative $3,000 balance right now, but you're gonna make that payment from the line of credit when it becomes due. So let's say after the first month, your ending balances are, you have nothing in the bank account, right? Because everything is shifting from the bank account over here, right? Um, so then your line of credit, you actually have $200 extra in that line of credit. And why is it $200 extra? Remember, your income minus your expenses for your budget is $200. So that extra $200 is what you're using to build back up the line of credit, right? And so, because right now you have a surplus of $200 in the line of credit, but you also keep in mind you have to pay back this negative 3,000 on the credit card, right? So it's kind of like you don't have the $200 extra in the line of credit, because when this credit card becomes due, which I'm going to show you right here next month, right here or whatever, then you have to pay that back from the line of credit. So hopefully that makes sense. Hopefully I'm not rambling on too much, right? So now you have a negative balance on your credit card. You owe $3,000 on your credit card, but it's not being charged interest on it right now because the due date hasn't come yet, right? And now the car loan, you drop that down to negative $13,000. Yeah, $753. So now you only owe this so much, and then your equity also, um, it increased because it was at negative 17,000. Now it's only at negative $16,553. Right. So now let's go down here into February. This is when your credit card payment is going to be due. So that negative $3,000, all those expenses, all your expenses from your budget that you made in January, now in February it becomes due. So how are you going to pay that? Because you're probably like, how am I going to pay that if I don't have no cash in my bank account? Well, you're going to take $3,000 from the line of credit and use that to pay back the credit card, right? And so now you have a negative $3,000 balance on your line of credit. But what you're going to do is, when your paychecks come in throughout the month, you just send those directly to the line of credit. That way that balance is reduced now, and then it's going to be less interest accruing on the balance, the line of credit balance, right? And so again, your monthly expenses, you're going to keep as much as you can on the credit card, right? It's like you're borrowing from the credit card. You're keeping as much as you can on the credit card until the credit card payment becomes due. And as long as you make the full amount, when the payment becomes due, you won't be charged any interest. So you're avoiding the interest on that. And then remember, again, over here, your from your expenses, from your negative $3,000 expenses, 267 of that is going to reduce the car loan. So keep that in mind as well. So some of it is going, some of the $312.90, some of it is going towards the interest for the car loan. Some of it is going for the principal, and this is the amount for the principal. Now, if you're looking at these two numbers, the 246 and the 267, it's like, okay, why did it jump so much? Like, why is the difference between 246 and 267 bigger than what it would be from, let's say, 267 to 267.94? And that's just because the calculator I used, it did it as if the payment was made before the chunk. So hopefully that makes sense. I hope you get it, but don't worry about that. Trust me, it's not a big deal. It's not. It won't make a big difference. Trust me, even if you don't understand what I just said. So now what you're gonna do, basically every month you're gonna keep doing the same thing. So this will be your ending balance after February. Your ending balance would be, you're at $400 now. See, it went from $200 to $400. So now you're building that line of credit back up with the extra $200. So every month it's going to be 200, 400, 600. See, it's going up by $200. You're building it back up with the extra cash flow, and you're avoiding the interest accruing on the line of credit by putting your paychecks into the line of credit. You see the 1600, you're avoiding the interest accruing as much because you're sending your paychecks there. You don't need money in your bank account because you can just keep borrowing from the line of credit. Hopefully that makes sense. And then you're going to use the credit card, right? You're going to use the credit card to put as many expenses on it as possible to stay away from you using your line of credit, because your line of credit is what's going to be you have to pay back over time, right? So you don't want to have a big balance on the line of credit because you want to avoid the interest. But the credit card, you just use this to put all your expenses on, and you just pay it back every month. Pay that $3,000 back every month from the line of credit. And so hopefully this makes sense, right? And then this $267, this is the principal part from the payment. So when you, not only did you make that chunk, but every month you're also making payments to decrease the car loan amount, right? So now, if you're wondering, now just keep in mind, this is the first chunk you made was $3,000. So if you have $200 every month, you're building your line of credit back up by $200. It's gonna take you 15 months to build that back up. So when we stroll down, right, everything is working the same. It's just a system. So once you go down to the 15th month, right, if you look at the ending balance after the 15th month, it's $3,000. So remember when you made that first payment, the $3,000 from the line of credit to go towards the car loan, now after 15 months, it caught back up. Now it's a positive $3,000. So now you have, you caught back up, right? Don't think of this as an extra $3,000. It's not an extra $3,000 because you still have to pay back that credit card. See, the credit card is at negative $3,000. So even though this is positive, this is at negative $3,000. So it's not like you have an extra $3,000. So hopefully that makes sense. I hope that makes sense. So now your your car loan has been reduced to negative $9,000. And then your net equity is the same. This is another way how you can know that your line of credit has built back up. Everything is pretty much flat now. The line of credit and the credit card. So now that you got the $3,000 back, you want to make another chunk. You build it back up. Now you make that second chunk. And so with this is the credit card payment and the chunk, right? And so you're taking $3,000 out the credit, $3,000 to pay back the credit card for the month, and then you're gonna take $3,000 from an extra $3,000 from line of credit to also go towards the car loan, to reduce the car loan, right? And then as you pay that back, if you can see the car loan principal, the principal amount of the payment went from $278 to $289, and that's because more money is going towards the car loan now. More money is going towards the principal of the car loan. Let's say that. And so and then keep in mind, this will be 2023, the year 2023. We started 2022. This will be 2023. So we're in April 2023. We're on the second year. So now you have your expenses Same thing. You keep as much as you can on a credit card throughout the month to avoid having a large balance on the line of credit, because this is what you're going to be charged interest on, right? And we're using the line of credit as opposed to the credit card because the line of credit has less interest, right? So that's how that's working. And then your paychecks, you're going to put it directly towards the line of credit to keep that balance low again, just to keep that balance low. And then you see how it's at $200 now. Again, remember earlier it was at $200 when we first started building it back up. Again, it's the same thing is happening. That extra cash flow from the income minus expenses, we're building it back up now. Building it back up. You have negative $3,000 on a credit card, which you're gonna use the line of credit to pay from, make the payment, right? Your expenses, same thing. You keep it on the credit card. Part of the expenses is going towards the car loan principal. Your paycheck is going towards back in the line of credit to keep the balance low. You see, it's just building back up. 400, 600, 800,000. It's building back up. The credit card is going to be pretty much the same every month. You're just using it and then paying it, using it and paying it, using it and paying it. Then your car loan, the principal, you're paying it with the monthly payments. You're just paying it back, decreasing the principal, right? Decreasing it. Hopefully you guys understand what I'm saying. Hopefully I'm not speaking too fast. Hopefully this is not confusing. So every month your net equity is increasing. It's decreased. The negative amount is decreasing, so it's actually increasing, right? Building back up. Keep your eye on this. 2,200, 2,400, 2,600, 2,800, and then right here is where, even though it didn't build back up the $3,000. Even though it didn't get back up to $3,000, we're gonna make that chunk right here. Why? Because now the car loan is only at negative $2,788. So we don't need the $300. We could pay it off right here in after the 29th month. We could pay that back. And so we're gonna take $3,000 of this is going towards the credit card payment, right? Still had to pay that back every month. And now the $2,788 is also coming from the line of credit, right? So after that, now if you look down here, the car loan is $0. You paid that back. It's done. So after the 29th month, you don't have the car loan anymore. It's done with. Now you just have to pay back the line of credit. You just have to pay back the line of credit. And so now keep in mind down here, your expenses, now your expenses are reduced. Why? Because you don't have to pay back that $312.90 monthly payment for the car loan. So now you have extra cash flow on hand to pay back the line of credit now, right? So instead of it being $200 building back up the line of credit, now it's like what, $512.90 building it back up. So now you see it's gonna start building back up. From 211, you get to 724, you get to 1236, 740, 1749, 2262, 2775, and then this will be the ending of it. This is where you pay it back, right here. And you can also use the net equity over here to see where you're at. Once you get back to positive, now you know you paid it back. You paid the line of credit back. It's built up, right? And so now your credit card, you just make that payment. The 268, 687, you take that from the line of credit. You pay that towards the credit card, and now your extra cash is $88. Now you can start transferring that back over to the bank account if you want, right? So now, yeah, you could just start paying it back now. And so over here, down here, I'm talking about the first. This is the interest saved from doing the chunks. So the first chunk, you were able to save $1,300. The second chunk, we were able to save $351. Third chunk is estimated at about $36. And then approximate line of credit interest, the interest that you accrue from using the line of credit, is $300, negative $300. So all of that together, you will save roughly $1,406. And you also paid the car back earlier, right? So remember, it was 6 years to pay the car back. Now the time to pay off the car was, in this scenario, is 2 years and 5 months. And the time to pay off the line of credit after you paid off the car is 2 years and 11 months. So it took roughly 3 years to pay back the car and the line of credit, rather than being 6 years. So hopefully this was, hopefully you guys understood this. I know it's a lot, so it can be confusing, but hopefully this makes sense. Yeah, hopefully this makes sense to you guys. And obviously there are just a couple of other things that you will need to know before you just jump out there and just do anything. But I don't want to get into that because this is a lot for this video already. So I'm not a financial advisor. This is not financial advice. I'm just showing you a scenario and showing you to study it and review it as well and things like that. But if you felt like this video was gave you some insight or whatnot, please consider liking, commenting, and subscribing, and I'll see you guys in the next video.